I have lived long enough to watch the same mistake return wearing different clothes. People call it innovation when it first arrives. They call it a regime change when it starts working. Then they call it obvious right before it breaks. What I have learned is that the most dangerous trades are not always the loudest trades. They are the trades people stop seeing as trades. They become assumptions. They become background music. They become the floor under every confident opinion. And when that happens, the loss does not begin with price. It begins with surprise. That is how I look at the dollar right now. A great many people have spent a long stretch of time behaving as if the dollar could only drift lower, as if liquidity would stay easy enough, as if risk assets could continue rising, while the currency that sits underneath the global system kept losing altitude. Once people start thinking like that, they do not merely express a view on a currency. They build portfolios around it. They finance equity exposure around it. They stretch into crowded positions around it. They use that belief to justify leverage, to justify duration, to justify owning what they should not own at the price they are paying. When I hear someone say the biggest risk in the market is whatever just made the headlines that morning, I usually become more interested in the quiet thing tied to balance sheets. The quiet thing is usually where the trouble lives. It hides in funding, it hides in positioning, it hides in the trade people think they can exit whenever they want. The short dollar trade has become one of those trades. The surface story looks simple enough. If the dollar weakens, it tends to loosen financial conditions. Risk assets breathe easier. Equities look better. Commodities often find support. International trade flows look friendlier. Capital moves toward whatever offers, and upside, a weak dollar can make a lot of other sins look manageable for a while. But what matters to me is not the poetry of a weak dollar. It is the plumbing underneath it. If you are short the dollar in one form or another, you have usually used that posture to own something else. You borrowed confidence from one side of the market in order to be brave on the other side. That means the moment the dollar begins to rise with force, the problem is not confined to foreign exchange. The problem spreads into everything that was financed by the belief that the dollar would stay soft. That is why I do not view this as a neat little currency discussion. I view it as a stress discussion. I view it as a funding discussion. I view it as a forced selling discussion. When a trade becomes crowded enough, the first move against it rarely looks dramatic. It looks annoying. It looks temporary. It looks like noise around a larger trend people still trust. Then the move keeps going. Then the explanations start changing. Then what began as confidence becomes urgency. People who were comfortable carrying the trade become uncomfortable. People who were overextended become trapped. And then the market does what it always does when too many people need the same door at the same time. It gets smaller. That is the setup that catches my attention here. The case is not built on one magic indicator. It is built on a chain of pressure. Oil rises. Europe suffers first because Europe is structurally more exposed to imported energy pain. The euro weakens when growth prospects weaken and trade balance pressure rises. The dollar index rises because the euro carries enormous weight inside that basket. And once the dollar starts rising, the whole collection of assets that was comfortable under a weaker dollar suddenly loses its easy backdrop. That sequence matters. Most people do not think in sequences. They think in isolated headlines. They look at oil over here, central banks over there, equity valuations somewhere else, the euro in another room, and the dollar in still another room. Real stress does not arrive that way. It arrives in chains. One thing presses on the next thing tightens conditions somewhere else. Then portfolios that look diversified turn out to be tied to the same root assumption. The root assumption here has been that the dollar would remain under enough pressure to keep supporting the appetite for risk. That assumption is weakening. I pay attention when a market stops rewarding the consensus and starts questioning its foundation. That is what makes this moment interesting. Not because the dollar has already made the full move, but because the logic that supported broad comfort against the dollar is being challenged from several directions at once. The first direction is energy. I have never been able to treat energy. Energy sits too close to everything. It runs through household budgets, freight, industrial margins, sentiment, politics, and interest rate expectations. A sudden rise in energy prices is not simply a chart event. It is an economic tax. It transfers strain into places that do not want it, and usually cannot absorb it for very long. Europe is especially vulnerable when energy rises hard and stays elevated. That is not ideology. That is structure. If energy becomes more expensive and uncertain, Europe feels it quickly. Growth gets pinched. Consumers get weaker. Industrial activity feels the squeeze. Trade dynamics deteriorate. And when a region already looks fragile, a fresh energy shock does not inspire confidence in its currency. That matters because the euro is not a minor decoration in the dollar story. The euro is the biggest piece of the dollar index. When the euro bends under pressure, the dollar can rise even before the broader public has fully processed what is happening. Then the market starts doing the arithmetic. A stronger dollar tightens conditions. Tighter conditions create more caution. More caution creates more demand for safety. And what sits near the center of that safety impulse, whether people like it or not, is the dollar. Now add the second direction of pressure. The market had grown comfortable with the belief that the Federal Reserve would deliver easier policy. That belief is not a small detail. It is one of the emotional supports beneath the short dollar view. If traders and allocators think the Fed is moving toward cuts, while other regions might remain relatively firm, it becomes easier to bet against the dollar. It becomes easier to imagine a softer currency, easier financial conditions, and another extension of the risk appetite that carried so many assets higher. But when that expectation starts getting pushed back, the posture changes. A dollar short is easier to hold when you think the central bank behind that currency is about to lean decisively toward ease. A dollar short gets more dangerous when those expected cuts move farther away, or when policymakers sound unwilling to validate the market's wish list. Then the trade loses one of its major justifications. Not all at once, not dramatically, but enough to matter. The third direction of pressure is what I would call a disappointment risk in Europe. Markets often fall in love with a policy path before the policy path has actually happened. They begin trading the story as if the story were guaranteed. They decide what a central bank should do. Then they price as though the central bank has already agreed. That can work beautifully until reality becomes inconvenient. If Europe is slowing, if energy is hurting, if recession pressure is rising, then the room for a forcefully hawkish European stance becomes narrower than enthusiastic traders might hope. If expectations lean too hard toward policy firmness, and that firmness fails to appear, the euro can weaken further. Once again, the dollar does not need some mystical new engine. It only needs the assumptions supporting the other side to lose credibility. That is enough. A market that is leaning the wrong way does not require a perfect catalyst. It only requires a good enough catalyst. I have seen many investors overcomplicate crowded unwinds because they want a grand explanation worthy of the damage. The market is more brutal than that. When positioning is extended, good enough is enough. A slight shift in rates expectations, a little more stress in energy, a little more weakness in Europe, a little more evidence that institutional money is stepping back from risk, and suddenly the move feeds on itself. That is the real concern. People like to talk about corrections as though corrections emerge from abstract nervousness. In truth, serious market declines often involve financing pressure and forced repositioning. Someone who is lightly long equities can tolerate a drawdown. Someone who is long equities while also leaning against the dollar, while also assuming easier policy, while also positioned for stability in Europe, is carrying more than one dependency. If several of those dependencies turn at once, losses begin to interact. That is how small problems become fast problems. I pay close attention when institutional behavior starts changing around a narrative the public still likes. Retail enthusiasm can survive on emotion for quite a while. Institutional capital usually becomes more careful when it senses the supporting backdrop is deteriorating. When large allocators reduce risk exposure, trim futures length, hedge more aggressively, or stop expressing the same confidence they held a month ago. I do not treat that as random. I treat it as information. It does not mean they are omniscient. Nobody is. It does mean the easy phase of the trade may be over. The market often gives two gifts before it takes one away. First, it gives a story, then it gives a period during which the story works. After that, it takes away liquidity. This is why I am less interested in the beautiful thesis that a weaker dollar supports everything, and more interested in what happens if the dollar begins behaving like a coiled spring. People who are short a currency do not lose money in theory. They lose money when they must reverse. They must buy back what they sold. And if they financed risk assets with that view, they may have to sell those assets quickly in order to do it. The speed is what hurts. You can survive a slow disagreement with the market. You can think. You can rebalance. You can wait for better prices. A squeeze is different. A squeeze turns reflection into reaction. It converts preference into necessity. And necessity is not price sensitive. That is the part too many investors dismiss. They hear short squeeze and imagine a dramatic phrase borrowed from television. I hear it and think about balance sheet mechanics. I think about funds with limits. I think about traders with stop levels. I think about institutions that never wanted to make a public scene but suddenly find themselves needing to buy dollars and sell risk. I think about correlations tightening at exactly the wrong moment. If the dollar rises sharply, it is not because the world suddenly became wonderful. It is often because stress is being recognized. In that environment, a rising dollar and falling equities are not contradictory. They are companions. That relationship has shown up again and again. When the dollar softens, risk can feel comfortable. When the dollar firms, equities often begin to lose some of their buoyancy. And when the dollar rises quickly, what had been a mild dip can become something rougher, because the move is no longer just about valuation. It becomes about access to liquidity, willingness to hold exposure, and confidence in the assumptions underneath the entire portfolio. I do not need a calendar prophecy to take that seriously. I only need to see the ingredients gathering. The source of the pressure is not merely oil itself. It is what oil does to expectations. Higher energy changes inflation chatter. It changes what central banks are able or willing to promise. It changes the ability of households to keep spending. It changes the tolerance of companies facing squeezed margins. It changes regional competitiveness. It changes politics. It changes sentiment. Then, after all of that, it changes positioning. A lot of investors talk about inflation as if every inflation impulse carries the same meaning. It does not. There is a difference between inflation emerging from healthy demand and inflation emerging from a shock. People cannot afford energy. Lead inflation can hit like a tax on the real economy. It can push prices up in the short run while simultaneously making the medium-term growth picture worse. That is a nasty combination. It can make central banks hesitant, markets confused, and households weaker all at the same time. That is why I would not casually assume higher energy is bullish for broad risk assets, simply because it inflates nominal numbers somewhere in the system. If wages are not keeping up, if hours worked are softening, if consumers are already tired, then higher energy is not a sign of durable strength. It is strain arriving through the front door. Eventually, strain shows up in spending. Eventually, it shows up in profits. Eventually, it shows up in credit. And when markets decide to care, they care suddenly. That is another reason I find the dollar setup important. It is not a standalone bet. It is a potential expression of broader recognition that growth and liquidity assumptions were too generous. If that recognition spreads, it will not remain politely contained inside one asset class. Investors who have been conditioned to buy every dip may discover that not every dip is a gift. Some dips are messages. Some are simply telling you that the supporting conditions have changed. You are not supposed to charge harder into every message. Sometimes the intelligent response is to reduce the size of your mistake before it becomes a thesis about patience. I have never believed that activity itself is wisdom. Most people lose money trying to look brave at the wrong time. What matters to me is preserving the ability to act later from a position. If the market is entering a phase where the dollar can rise because short positioning is being unwound, if that rise threatens broad equities and credit, then the first duty is not heroism. It is survival. It is making sure you are not one of the people whose portfolio requires everything to go right at the exact moment the world is starting to get less cooperative. That is why the practical response matters more than the dramatic language. If I were highly exposed to broad market risk after a long favorable stretch, I would not treat this environment as a place to reach farther. I would treat it as a place to become more selective and more liquid. If a large share of my portfolio had been benefiting from the same easy backdrop, I would cut that exposure back to a level that lets me think clearly if volatility accelerates. 10%, 20%, 30%. The exact number depends on the starting point and the investor, but the principle does not change. Reduce what depends on a continuation of the crowd's favorite assumptions. I would not confuse trimming with surrender. I would call it room to maneuver. There is a big difference between being bearish on civilization and being disciplined about a specific setup. A stronger dollar can pressure the market without ending the future. It can create a sharp correction without meaning stocks will never recover. In fact, the very violence of an unwind often sets up the next opportunity. But that opportunity belongs to the investor who still has flexibility when the dust settles, not to the investor who used all his emotional and financial capacity defending the old trade. That distinction is everything. When I listen to excited market commentary, I often hear people jump directly from, there may be a hard down move, to therefore I should become wildly aggressive on the short side. I do not think that way. I think in stages. First comes the recognition that a crowded posture is vulnerable. Then comes the trimming of risk. Then, if conditions worsen, comes the possibility of selective hedging. Then, much later, after the unwind has done real damage, comes the search for assets that were unfairly discounted. Discipline means not skipping the order. Right now, the sequence that makes sense to me begins with respect for the dollar, not because I worship currencies, not because I think every tick is destiny, but because the dollar rising here can be the market's way of revealing stress that many investors still prefer not to discuss. The chart-minded crowd may frame this in terms of ranges, resistance, breakout levels, and upside targets. I do not object to that language. Markets do move through levels, and levels can matter because people act around them. But the deeper truth is that a breakout is powerful only when it forces people to reconsider what they thought was safe. The chart is not the cause of the panic. The chart is the picture of the panic. If the dollar is pushing out of a zone where sellers have repeatedly felt comfortable leaning against it, then every incremental move upward carries a second effect. It does not just reward dollar bulls. It punishes people who believed shorting the dollar was routine. Once that punishment reaches size, supply appears in whatever they must sell to finance the reversal. That is how one market migrates into another. So when I think about broad equities in this environment, I am not starting with earnings models or optimistic trend lines. I am starting with a question that matters in real stress. Who needs what, and how badly do they need it? If the answer is that many people need dollars more badly than they admitted, that alone can explain a great deal of market behavior over the next phase. I also do not ignore the irony embedded in the oil story. In the short run, elevated energy can intensify the pressure that supports the dollar. Yet some of the very arrangements designed to ease the immediate strain can hint at something else down the road. When borrowed barrels must later be returned with a premium, it tells you that there are participants willing to act today, because they believe prices may be lower by the time repayment matters. That does not erase the current risk. It simply reminds you that panic phases and opportunity phases are different phases. I would not rush that second phase. That is another common mistake. People are often early because they are emotionally tired of being cautious. They mistake exhaustion for insight. They say, surely the move has already gone far enough. Markets do not care how long caution has felt uncomfortable. A forced unwind ends when the forced participants are finished, not when commentators become impatient. So even if I can imagine a future moment when oil becomes an attractive short, or when broad equities offer a superb rebound trade, I would not let that future possibility cancel the present danger. The present danger is that a lot of portfolios were built on a softer dollar, easier policy, and a world in which Europe's weakness would not feed back hard enough into the currency system to matter. If those assumptions are being repriced together, the correction can be harsher than people expect. I have no interest in pretending certainty about the day or the week. I have great interest in respecting asymmetry. When a market is crowded, upside from staying with the crowd is usually smaller than people imagine, and downside from being wrong is usually larger. That is not a prophecy. That is the arithmetic of saturation. If everyone is already leaning one way, who is left to keep pushing it? But if there are plenty of people available to reverse. That is why crowdedness is dangerous. Not because consensus is always wrong, because consensus stops giving you a margin of safety. And margin of safety is not a phrase I reserve for stocks. It is a way of thinking. It applies to capital structure. It applies to valuation. It applies to portfolio design. It applies to leverage. And it certainly applies to moments when a trade has become so comfortable that investors barely remember what the opposite move would force them to do. Here, the opposite move is a stronger dollar, not a little stronger. Strong enough to make people rethink what they own. Strong enough to make Europe's vulnerability more visible. Strong enough to expose how much risk appetite depended on policy expectations that may not arrive. Strong enough to turn a fashionable macro posture into a scramble for cover. Whenever I see that kind of setup, I try to simplify my thinking. Complexity is seductive when people are afraid. It creates the illusion of control. The truth is simpler. If the dollar is rising because energy pressure is colliding with European weakness and fading hopes for imminent Fed easing, then that is not a backdrop in which I want to be casually overextended in broad market exposure. I want more resilience. I want more cash. like optionality. I want less dependency on a single popular narrative. If I were trading tactically, I could understand expressing that view directly through the dollar. If I were investing for the longer term, I would view dollar strength more as a signal to reduce risk than as a reason to become theatrical. Raise quality. Trim excess, refuse leverage, keep enough dry powder that a later dislocation becomes useful instead of fatal. That is how I think about protection, not as panic, as preparation. The crowd usually imagines that danger announces itself with clarity. Real danger often announces itself by making a formerly easy trade feel a little less easy. Then a little less easy becomes uncomfortable. Then uncomfortable becomes expensive. Then expensive becomes urgent. By the time the public story catches up, the disciplined investor has already done the most important work. He has stopped asking the market to be kind. He has started asking whether his portfolio can survive if the market is not. That is the question I would ask here. Can it handle weaker equities at the same time? Can it handle the possibility that the Fed does not deliver the relief many had counted on? Can it handle a Europe that is more fragile under energy strain than consensus wanted to admit? Can it handle the fact that a large short dollar posture, once it starts to unwind, may not stop just because people think it should? If the answer to those questions is uncertain, then the course is not difficult. Reduce the exposure that makes those questions frightening. You do not need to know the final bottom or the precise path. You only need to know that the market is beginning to challenge a set of assumptions that had become too comfortable. Comfort has ruined more portfolios than complexity ever did. So I would approach this phase the same way I have tried to approach every crowded setup throughout my life. I would assume that the most popular trade contains more fragility than it appears to contain. I would assume that liquidity is most available before it is needed. I would assume that safety bought a little early is far cheaper than safety bought in the middle of a scramble. And I would remember that the best opportunities usually arrive after the forced sellers have finished, not before for now. The signal is caution, not paralysis, not melodrama caution. Respect the dollar. Respect what higher energy is doing to Europe. Respect what fading rate, cut expectations can do to positioning. Respect how quickly a comfortable market can become an urgent one when a crowded short starts reversing. And above all, keep enough flexibility that when the next genuine bargain appears, you are one of the few people able to act instead of one of the many people still trying to escape the last mistake.